So let's answer the question of, can you actually day trade with less than $25,000 in your trading brokerage account? The short answer is yes, you can. I've seen as small as about $100 in someone's trading account, $500, and $1,000 from people that have all been day traders with way less in their account than $25,000. So it's 100% possible. And it's possible because of what I'm going to show you here and the small tweak you can do, because again, you don't need $25,000 at all. Now, to start, you need to understand, what is a day trade. A day trade, as you can see throughout this, is just simply you buying and selling, let's say, SPY option contracts on the same exact day. So if Monday you bought SPY option contracts for $100 and sold those same contracts on that same Monday for $100, so break even, I guess, then that's exactly one single day trade. Now, here's the problem. When most people sign up for a Thinkorswim account, or most accounts, they're automatically by default sign up for what's called a margin account. A margin account is subject to what's known as the pattern day trader rule. The PDT rule, which is what it's short for, basically says that if you take 3 day trades, that's fine. But if you take 4, so if you execute 4 or more day trades within a 5 business day period, then you're going to get flagged as an actual pattern day trader. The problem with that is that since you have a margin account, you're flagged as a PDT trader, then you're essentially going to be banned for X amount of weeks from doing any trades. From a day trading perspective, you just literally can't make any trades because they're trying to quote unquote help you to say, hey, we don't want you to lose all your money, so we're going to flag you so you can save your money. Honestly, it's the truth. I've asked a lot of people in the investing world, and that's literally it. So, but let's go the other route. Let's say hey, you're ready to be able to make more than 3 trades a week or within a 5 business day period. What's the next step? The next step is to graduate from that margin account, or just say don't sign up for that margin account in the first place and say I'm ready to trade much more now, regardless. The way to graduate and do the next account to get past that PDT annoying rule is to set up a cash account. So a cash account is not subject, as you can see, our cash account subject to PDT rules. The answer from Thinkorswim directly on their website is no. Cash accounts are not subject to the PDT rule, and as such, you don't even need to use the counting tools in Thinkorswim to count how many trades you're doing, because it doesn't matter. Now, the way the cash accounts work is that versus a margin account. So let me take a step back. There's 2 accounts, right? There's a margin account and there's a cash account. A margin account, to go with that one first, it's basically, if we can imagine an account that's $10,000. Let's say you're buying whatever stocks, and you say, hey, I want to buy, I don't know, a $9,000 worth of stocks on Monday, and then I want to sell those same exact stocks also on Monday for a slight amount of profit. Instead of $9,000, you sell it for 9,500. Great, that's perfect. So you ended up selling and you got some profit, right? But your account will show $10,000 plus $500 because you made that profit, correct? Right? So that's great. And that means hypothetically, if you go back, you can make another trade and say, hey, I want to make this another $9,000 trade, so maybe I can get another $500 just mathematically. The play's there, etc. So you can do that. You can use that same money because technically you put the money in the account, but you're borrowing against it. Now with the cash account, you're only using your cash, hence the name cash account. So if you have a $10,000 account and you make a $9,000 trade, after that you don't have any more. You don't have that $9,000 that one day. You only have $1,000 left to trade, which when you think about it, can potentially be better. So if you have a $10,000 account, the way to do it is to make a $1,000 trade and make a few bucks on that one, then make another $1,000 trade and make a few bucks on that one, and so on and so forth. So hypothetically, if you're making $1,000 trades, you can make 9 to 10 different trades if those are the cost of the trades on a transactional perspective. You can make way more trades that way. So that's the workaround around it. And as far as, let's see this next piece here, the next part, this kind of explains the settlement times when it comes to this, because I was talking about that a little bit. So with cash accounts, it's your money, so you have to essentially wait for the settlement times to actually settle back into your account to use the cash again. Now, again, I trade specifically SPY options. So the settlement times, if you don't do that, you only do, let's just say stocks, is T plus 2 business days. So you're getting your money in 2 business days for stock trade specifically. Now, if you're doing options, it's literally one. So this next example here, as you can see, this is the T plus 2. So if you bought XYZ stock on Monday and then sold it on Tuesday, the funds would then be available on Wednesday, basically, because you bought it on Monday, as an example. So boom, you get it actually on the Tuesday, as you can see with the following example. So that's essentially the difference between a margin account and a cash account. So again, the answer to the question of can you actually day trade with less than $25,000? The answer is 100% yes. You just need to set up that cash account and then you'll got the ball rolling.